Okay, any questions or comments so far? You know, we've talked some FASB Accounting Standard updates. We didn't hit a lot of the ones that have been recently issued. I will tell you this, most of your standard setters have been relatively quiet on the issuance front. Because of all this, they've pushed some effective dates out on a lot of areas that they've already issued. Even with RevRec, you know, if you had folks who, as of June 1st, really hadn't issued it, not really hadn't issued their financial statements, they could get a deferral for another year to have to put it into place. So there's not been a whole lot going on. I'm not sure when it's going to ramp up again. I don't think anybody is sure when it's going to ramp up again, but hopefully it will before too much longer. Okay, so any comments or questions so far? Okay, we'll get ripping then. There's the core principle. We talked about what that is, and there's your 5-step process. Hopefully by now, we're all familiar with what the 5-step process is. Or, you know, first we got to determine do they have a contract. If they got a contract, then we talk about performance obligations, what a performance obligation is, and we'll talk about the transaction price. Then we got to allocate that transaction price. Then finally, we're able to recognize revenue as we satisfy these performance obligations. So we'll just go through these, maybe talk about how they might apply to some of our customers and clients, and maybe how we've addressed these issues with them. First of all, you got to determine, do you have a contract? And I told you all earlier that, you know, when it first came out, I said, I've only got a few that have real contracts. Well, no, when you read a little farther, they all have real contracts. And those contracts do not have to be written, but there's your criteria right there. I remember going through an A&A update with a group, and there was somebody there, I think it was the firm, and they had, you know, friends of the firm there, and there was somebody from a utility department, and the utility department said, you know, electric utility, I think is what it was, says, well, we don't really have formalized contracts, so I really don't think this is going to apply. I said, well, I think you're probably wrong. No offense, but I think it will apply. She's like, don't think so? I said, we'll go through this scenario then, right? And there's your required contract criteria. You got a contract that's been approved by both parties. Both parties are committed. You got the rights of each party that can be identified. The payment terms can be identified. It has commercial substance, and the collectibility is probable. Now, you know, if they don't hit that last one, they don't have a contract, and we'll talk about that a little bit farther. So let's take this to the utilities, right? So when she says we don't really work with formalized contracts, I said, it doesn't have to be formalized. She said, well, I don't think we have contracts at all. And then we go through this scenario, right? I said, so why would somebody come to you? She said, well, they need power. I said, you got the power, right? She said, well, yeah, I guess I kind of do, right? I said, sure you do. So somebody's building a house, they come to the utility department. I said, I need utilities run out there. I said, what's your next step? She says, well, then we'll run a credit check on them. I said, why are you running a credit check? Well, to make sure they don't have any issues. Collectibility of consideration is probable. So they're getting to that standpoint. I said, what happens if they don't have good credit history? She said, well, make them put down a bigger security deposit. I said, okay. I said, so then what's the next step? Well, the next step is where they need it, when they need it turned on. We tell them about what our billing procedures are, and when we, you know, when we expect to get paid, and when we'll cut off services. I said, do you know you just hit every one of those up there? Because contract's been approved by both parties. So we don't have a sign, you don't have to. It can be verbal. And so, you know, you have agreed to provide them power because they need power, or electrical utilities, whatever it happens to be, right? They want it, you got it, you said, if you follow these, we'll give it to you. And they said, okay. So you got something that's been approved by both parties, both are committed, they stroked a check for $250 or $500 right then based on what their credit was, and gave it to you. So, you know, you've got some consideration given it, and once they give that to you, they're committed to providing them with a power source. The rights regarding the services can be identified. Yeah, we told them that, you know, to get it turned on, you got to have a security deposit, and then you're going to get billed, and that bill is due by the 6th of each month. If it's not paid within, you know, X number of days, we'll cut your power off. We can do that from the comfort of our own office now without having to go out there and shut it off. And so, you know, the rights regarding the goods or services are identified, the payment terms are identified, the contract has commercial substance, and collectibility is probable. If they have such a poor credit history that you say we can't run power out there unless you prepay 6, you know, it's going to be probable for at least part of it, right? And so she finally came down and said, well, I guess it does that. And so again, I think if you go through that scenario with every client, and even if a client is at first hesitant to say, I think at the end of the day, we have found that everybody is subject to revenue recognition under Topic 606. Now, when we get down to the whole collectibility criteria, right, it has to be probable. If the collectibility goes under probable, remote, reasonably possible, if the intent and the ability to pay has been diminished, then you no longer have a contract. And that's what 2016-12 addressed. And it says, hey, we may have to assess this contract over time to determine whether it's still valid or not. So for some of these long-term contracts, take the utility company, right? Let's just say that they're kind of reassessing the validity of this contract because they hadn't been paid in 2 months. At that point in time, the client's intention to pay has been compromised. So they may no longer have a contract. And so when that contract fails to meet the customer's ability and intention to pay, revenue can only be recognized to the amount of consideration received, and such is also non-refundable. So that could be that they hang on to that security deposit. Maybe that's all they can, you know, receive. Another example I give is for like a long-term construction project where you're looking, you know, over time, and maybe you've got some investors who get together who want to build an office building, and let's just say it's a $5 million building. And so these 5 investors have all, you know, pitched in, so they got financing in place. They put down a $100,000 deposit, non-refundable deposit, and 6 months into the project, three of the investors pull out. And the other 2 investors can't come up with that kind of scratch to back the rest of it. So the ability and intention to pay the promised consideration has fallen below that probable threshold. So at that point in time, they can recognize revenue only up to the amount of that non-refundable deposit. Okay, so it's an assessment period going through to determine whether you got a contract or whether you don't have a contract. Now, you know, does this happen in all of your customers? You know, are all of your clients, you know, evaluating with each one of their clients, you know, their ability and intention to pay? I think probably so, really. It may not be a formalized type thing, but you go to your client, you ask them with their AR, with their accounts receivable. Hey, by the way, these have gone over 60 days. What's the likelihood of it? Yeah, that's not good. We're not going to get that. So they make this assessment. And so again, we've got to consider this going on. Then we talk about, can you combine contracts? Well, yeah, if it's a single performance obligation, so negotiated as a package deal, single commercial objective, you know, sales of a product and service. That's typically, you know, I always like to talk about cell phones and cell service. Cell phone does you no good unless you have service, right? Service does you no good unless you have that cell phone product. So that's a single package deal, basically. So you can do it that way. They're negotiated as a single commercial objective, and you can combine both of those contracts together. The amount of consideration paid in one contract is dependent on the other, or the goods and services are a single performance obligation. Again, I go back to like residential construction contractors. For years I thought, I wonder how they're going to handle this. If they like to do, you know, percentage of completion and so forth like that, will they see these things as separate performance obligations with, you know, HVAC and then plumbing and sheetrock and foundation work. No, they don't typically do that. They'll just put in there that we have the ability to be paid over time, okay? But they'll combine all those type things into one single performance obligation of here's your structure. It's got everything that goes into it, right? Now what happens when you have contract modification? You know, that's what happens when both parties agree to either change the scope or change the price. You'll treat it as a separate contract if these additions are distinct and if the price of the new obligation is consistent with the standalone price. Again, you don't see this in every type of industry, these contract modifications, and certain ones you do. You know, let's just say my lumber mill client, let's just say that they've got a contract with a customer to provide them 10 truckloads of lumber. Somewhere along that line, they go and they have to make some modifications that goes from 10 trucks to 12 trucks or 15 trucks, or it changes that way. And those are the type of things you would consider, right? Maybe you adjust the current contract if it's not treated as a separate contract. So, first of all, you got to determine you've got a contract. Written, verbal, normal business practice, whatever it is. We've got to determine if we don't have a contract, we can't recognize revenue under Title 606. So, that leads us into the whole performance obligation. By the way, what is a performance obligation? Everybody know what a performance obligation is? Y'all issue financial statements with this, right? I'm just curious to know. What's the performance obligation? You know, there are required disclosures around what performance obligations are, right? Promising a contract to provide a good or service, that type of thing. So that's what a performance obligation is. That we're going to transfer to them either a good or service that is distinct or a series of goods or services that are substantially the same. So in this first one, you know, we're selling them whatever, clickers. And so we've got these, you know, slide advancers. We're selling them a product. Or in that second one, a series of goods or services that are substantially the same, have the same pattern of transfer. In our office building in Huntsville, we have somebody who comes and cleans our office space the same time each week and we've got like a 2 or 3 year service contract with them. And so that's all that is, okay? A series of services that are substantially the same, that have the same pattern of transfer to the customer. There are some examples: constructing, manufacturing, developing an asset, granting licenses. Now those licenses, you got to determine what do they do. Does this just give us access to use this, you know, whatever program, or does it also give us the ability to have updates, maintenance, those type of things going forward? Granting options to purchase additional goods or services. So when we think about coupons, those type things are also considered to be a performance obligation. Now again, it talks about they have to be distinct, and to be distinct, they have to meet those 2 criteria, right? They can benefit from it on its own or together with other resources that they have. And the promise to transfer that good is separately identifiable from other promises in the contract. You know, if they're distinct, they're separate performance obligations. If they're not distinct, you'll combine them until they do become distinct. So that's performance obligations. So that's step 2. And you know you're required to disclose in the financial statement, your clients are required to disclose in the financial statements. Typically, what they determine to be a performance obligation, and typically when those performance obligations have been satisfied, those type of things are required disclosures, right? And so then it's the whole transaction price. Did this really change? You know, the determination of the transaction price, did that change with your clients? Did their whole pricing structure change under Topic 606? Shoot, if it did, man, our clients missed the boat because they didn't really change the lid. May have changed some of the terminology around it, may have changed some of the way that they allocate, part of their transaction price when you get to the whole allocation of it. But for years, the whole transaction price has been made up of what? Fixed and variable amounts. My lumber customer, it had a fixed amount and a variable amount. Okay, that fixed amount, this is what you pay per truckload. If you pay, within 10 days, you get 2% discount. That's variable. But if you don't, you do the full, you have to pay the full amount. So they're full of fixed and variable amounts. Use customary business practices. Now, it could be at some point in time, there was somebody who said, hey, we don't advertise this, but we always give service with our sale of the product too. And so that's normal business practice. And then maybe you allocate a part of that transaction price to not only the sale of the good, but the service also. And it could be the sale of goods at a point in time, and service extends over a couple of years, that may be overtime, possibly. And so that's some of the consideration that goes into that. But a lot of them have both fixed and variable components to it. Then we talk about, what is variable consideration? What about this significant financing component? What about non-cash consideration? So what is some variable consideration with some of your clients? Any of your clients offer like a frequent buyer club? Buy X number, get something free. Do they offer coupons, discounts, refunds, rebates? Cat got your tongue kind of thing. Even with some of our government contractors, they know that they have to meet certain criteria or they won't get full reimbursement for some of these type of things. So it has some variableness to it also. It's not always fixed. Think about your construction contractors, right? Are there some areas for wiggle room within there because of certain things? Possibly. So you could have some variable consideration within that.
What about like volume discounts?
Yeah, that's absolutely, that's variable, right? Because it doesn't happen until you hit a certain number. But once you hit that number, then that discount applies either to one or to all the rest purchased after that. And that's variable. And so when we get to the allocation of it, how do you allocate that? We do it to the whole group unless it's just for normally one, okay? So let's just say you got a quantity discount that says buy 50 of them, and then when you get to 51 and above, you get a reduced price, right? That's variable. So when we talk about how you determine what that price is going to be, you can use a market assessment approach, a weighted average approach that says, hey, here's how it's allocated to all of them. Or you can use the most likely method that says, hey, 90% of the time, people order over 50 of this product. And so they're going to get it, and you would use the most likely value. We'll have that slide coming up, but that's an area where we talk about how do you value this variable consideration when it comes to what it is. And quantity discounts is one of those.
Any difference, if quantity discounts where you maybe reduce the purchase price, what if I offer rebates once you receive that?
If you offer a rebate, that also, because that's basically cash paid to them, right? You would also reduce the transaction price at that point in time.
But do you change how you recognize the revenue rebate situation?
Yeah, right now we use allowance accounting, right? And so we use the actual number of rebates we pay out. In theory, what this says is you got a couple different ways to figure out whether that's the actual or whether it is a variable amount that you use an estimate to use. And when we get to that slide, I'll kind of show you what I mean. Because just like my lumber mill, right? They know what discount because they use allowance accounting. Here's the number of discounts, cash dollars that people have taken advantage of during the year. Well, in theory, this thing says, well, you'll kind of look at a 5-year history to see what the average is, and that's the amount you're going to record. Okay? And maybe that's right in line with we did this year, it may be slightly different. That's where we get into the disclosure of accounting estimates, because that's kind of a big thing going forward also, okay? Here's variable consideration. It's variable. The variable component can be estimated, and that variable component really is required to be estimated under 606, okay? We use this probability weighted approach or the single most likely amount, whichever one's more predictive. Let me give you an example. This would be like a service, right? Let's say I've got a 2-year service contract with you that says, hey, I'm going to provide consulting services to you over these 2 years, and the contract price is $200,000. Okay? So for 2 years, I got $200,000. But I'm going to throw some variable consideration in there that says, hey, if at the end of that contract I've helped you with your processes, you know, to gain a 10% better realization of whatever, then I'm doing another $20,000. Okay? And if I don't, then I pay you back $10,000. So I'm kind of like the IRS. I'm going to get more than what I expect you to pay. You have to pay me more than what you expect to get from me. And so, if I just go straight probability weighted approach, then I'm just going through the numbers, you know, and go through it like, because here's another part of it. 80% of the time, I get the $20,000 bonus, which means 20% of the time I don't. And so I use a probability weighted approach right there and go through the number work. And that would be for an amount that's less than 220, which would be the full amount if everything was good. Or I can use a single most likely amount. And if 80% of the time I get that, well, to me, that's the single most likely amount. Then we would record revenue at 220. Okay? Use whichever one's more predictive. This is an area where I think if we went through all the computations with our clients, we could come down with a different number than what was transpired in the past. I think would it be material? I don't know that it would, but it could, you know, because you get enough of these contracts, the full 220 versus less than 220, you could have a cumulative effect, possibly. But I don't know that all of our clients, well, I know all of our clients don't go through contract by contract like that, because they still use the underlying accounting allowance records of it. So that leads me to the question, so when we audit that, how did we audit that this year? You know, and what we basically did were like reasonableness tests. And we did some tests where they had some, with these discounts and so forth like that. And so we took an average over the past 5 years of who took advantage of those, and we had what the tabulation was of that. We compared it to what they had recorded at this point in time, and it was within spitting distance. We didn't put spitting distance in our audit documentation because that's not really a technical term, but it was that close. It was very close based on our predicted test of what it was. And I think if we went through that with every side, I think that would probably be the case. You know, unless you're dealing with like some of these fast cash places, you know, where they just never know what they're going to collect. They're doing these easy loan. Y'all do any of those type of places? Easy finance loan places, you know, where they can give you a car tire. We don't do them either, but I know firms in the past who have, because we talked about this. They're like, man, are you kidding me? I don't think I'll ever get to a contract with a customer because you think it's probable all these cats don't pay. They're not getting money from this place because of their ability and intention to pay. You know, they're getting them because they can't get it anyplace else. I said, well, you know, it could be that they have the ability and intention to pay, but the variable consideration is so large that the amount you're going to record is about 30%, you know, of that and so forth. So I think that's kind of the thought process that goes into it, okay? And of course it says include in the variable consideration only to the extent that it's probable there's not going to be a reversal of that in the future, okay? So that's, in theory, how variable consideration is handled. Although in actuality, the underlying accounting for it, our clients still use allowance accounting. we test the reasonableness of it based on how topic 606 says we should record variable consideration. Now, significant financing component. Again, this is if the period between delivery and payment is a year or less, we don't even consider significant financing component. But what I like to think about this is things like membership fees. Let's just say I'm going to join a health club or something like that, and it's a 3-year contract. And if that 3-year contract says, hey, you pay cash up front, it's $3,000. Or if you decide to go on a month-by-month basis, it's $110 per month. Okay? Now, you know, if you do the math pretty quickly, you'll go through 110 by 36. That's more than $3,000, right? So you've got a financing component. Because topic 606 says you'll recognize revenue of what the cash price would typically be. And so then on a month-by-month basis, if they're recognizing revenue under topic 606, instead of recognizing revenue at $110, you're taking, you know, your financing component of that. And so you're probably recognizing about $90 revenue from contracts with customers, and the remainder is interest income. Because the topic says it's recognized as the price the customer would have paid if the customer would have paid cash for it. And so they say, hey, you pay cash up front, $3,000. That's the amount of revenue we're going to recognize. So even though we're getting paid more than that on a month-by-month basis, the difference goes to interest income. You got a financing component. Okay? Non-cash consideration, which means you bought, you know, 5 t-shirts and you get a free cap. Well, how do you measure that cap? Because that's going to be part of your price, right? Measure fair value. Standalone selling price. I mean, that's pretty simple, right? Consideration payable to a customer. These are your, you know, cash payments, your refunds, coupons, credits, those type things. You'll treat it as a reduction of revenue, unless it's in exchange for a distinct good or service. And again, that's, you know, cash refunds, coupons, or other credits that can be applied against amounts that are owed. And that's your transaction price. Again, our clients didn't change the transaction price. They, you know, unless they raise it for inflation, whatever that type of stuff. It's nothing out of the norm. But as we're having these discussions with them and their documentation of the revenue process within their narratives that we include in our audit files, we try to make sure this year, we really try to make sure that those were rewritten to reflect the language of topic 606. And so then we allocate that transaction price. You allocate it to each performance obligation within the contract in a systemic manner, which means pretty much straight line, however you like to handle it like that. Standalone selling price is typically the most common method. If it's not sold separately, you'll estimate a separate price using an adjusted market assessment approach, cost plus or residual value, and then discounts. Again, you would allocate the discounts to all performance obligations proportionally, unless it's typically only for one instance within that. Okay? You know, 10 truckloads. Truck 1 through 5 are at $10,000 a load. Truck 6 will be at $9,000, and then trucks 7 through 10 go back to $10,000. That's just, you just allocate it to that one performance obligation, right? But if you say, hey, trucks 1 through 5, $10,000, trucks 6 through the rest of them at $9,000, then you take that average and you would allocate it to the whole group. So that's what we talk about when we're talking about allocating discounts. And then finally, step 5, we can recognize revenue once those performance obligations have been satisfied. Now for your construction contractors, right? The question is do you recognize revenue at a point in time or over time? And so we got to think about first, it's recognized when performance obligations are satisfied by transferring goods or services to a customer. And so when we think about the construction contractors, right? If they see that contract as one single performance obligation, residential construction, right? One single performance obligation, that basically says, hey, they can't recognize revenue until the performance obligation is satisfied. And that doesn't happen until they transfer that to the client, or the client obtains control of the asset. So that's why my initial thought process is, maybe they see these as separate performance obligations. But then, when we talk about control, right? Control refers to the ability to direct the use, obtain the benefits of the asset. Well, a residential home builder and the person who's having it built, they're not going to go live in a house that just has framework up, right? Doesn't have any insulation, ductwork, sheetrock, and all that type of stuff, so they're not really obtaining all the benefits of it. They have the ability to prevent other entities from directing the use of and obtaining the benefits. They may fit that, right? And then determine whether control of goods or services is transferred at a point in time or over time. And this is where I think we can get into the whole, percentage of completion. We can recognize it over time. And I think that's where most of them have gone, right? And so, when performance is satisfied at a point in time, this is the standard says you'll recognize it at a point in time. I hate it when they do this too. If the criteria to be satisfied over time are not met. It's kind of like the default. But if you don't meet this, you must do that. It's kind of like the plug with goodwill, right? And so anyway, the point in time is when a customer obtains control of the asset and the entity satisfies the performance obligation. Well, for these construction contractors, that doesn't happen until the end of the contract, basically. Whenever you've got a CO and they can take control at that point in time. Here's some of the indicators that control has been transferred. Entity has present right to payment, legal title, physical possession, significant risk and reward, accepted the asset, really similar to what we had even before topic 606. But now let's look at it over time. Recognized by measuring the progress toward complete satisfaction of the performance obligation. And this is where it hits with our construction contractors, right? Because they've always done this. And so one of the following criteria must be met. This is, when you see a term like must in the standard, that's an unconditional requirement. That's not one of those you say, well, they kind of came close, so we'll do that. No, must. They have to meet one of these following to be able to recognize revenue over time. Customer receives and consumes the benefits as the entity performs. Now think about service contracts then, right? I'm going to a clean office with our maintenance. So over time, we can do that because they do this on a regular basis. I am receiving and consuming the benefit as they perform it. And so with that, I'm good with that over time. The entity's performance creates or enhances an asset that the customer controls as the asset is being created or enhanced. Residential construction, I don't know that I really am controlling the asset as it is created. Maybe I am to a certain extent where, maybe I want to have some modifications and can do that type of stuff. But that contract pretty much says what's going to happen. But this last one I think is where they hit it. The asset created has no alternative use to the reporting entity. Now with the residential construction contractor, maybe they can sell to somebody else. But you look at this, and the entity has a right to payment for the performance completed today. And that's typical in these contracts, right? We'll bill you as progress takes place. Okay? Think about, if I'm thinking about somebody other than a residential construction contractor, let's just say we're working with a GC who's building a hospital, right? And so they meet, the people who have signed the contract for the hospital, they're not consuming the benefits as the entity performs. Now, what that hospital does for the GC will create an asset that the customer controls, as well, no, not that. But look at this last one. They've created an asset that has no alternative use for the GC. I guarantee you, the general contractor is not going to go out and build a spec hospital. You ever seen that? You see some spec residential. Hey, you know what? I just got some extra cash laying around. We'll build me a hospital. I'm sure somebody will buy it. That doesn't have any alternative use. They can't use that type thing. And they have a right to payment as time goes on. And so, again, this fits the way they've handled construction contracting for a number of years, I think. And so how do they measure progress? And let me ask you this. Y'all do some residential and commercial contractors? That work in process schedule that they provide for us, is that thing an exact science? It's not, right? Usually kind of comes down to where we fall out on the tax side of it. By the way, here's where we're at on taxes. Not sure that contracts in progress is right, and I know I'm on a completed contract method there, but I'm not sure that all these, and it's not really an exact science. And even under 606, I don't think it's an exact science because it's still an estimate, right? They're still estimating completion to date. Now, there's a couple ways they can do it. They can use input method or output method. So whether you're going to use direct materials, direct labor, those type things, if you're going to use appraisals, or whatever it is that they determine to use, make sure they use the most reliable information. And use it on a consistent basis. Otherwise, you'll recognize revenue only to the extent of costs incurred. Okay? So that's revenue recognition on topic 606. Yes, sir.
Is there an inherent difference between the general and the sub, though? I mean, the sub, in the general, they have a building until it's complete.
Right.
But that sub, they want to do part of the work.
That sub would see that as a separate performance obligation. Hey, I'm an HVAC guy, and I'm working for this GC, this GC, this GC. Separate performance obligation like that. So they can recognize theirs at that point in time. Because the GC is recognizing that cost over time. Yeah. Good. Any other comments, questions? So, after all those 5 steps, there may or may not have been any difference in revenue recognized. There may or may not have been any difference between the timing of it. At one point in time, I thought there may be some differences in timing, but for us, at least this initial year, we didn't run into any of that. Now, if we have some that have contracts that carry over, that may have some assets that they set up in terms of those contracts, potentially at that point in time, we didn't run into it this year. Okay, we could. But when it comes to the disclosures, that is where we found significantly more disclosures in the current year than we have in the past. Because in the past, what's been our disclosure for revenue? We recognize revenue on the accrual method of accounting, which means we account for revenue when it's earned rather than when it's received. And that's been it. If you're in the construction industry, maybe you have a few more that talks a little bit about it. But even at that point in time, you don't have the sheer volume of disclosures that Topic 606 requires. So, right now, for most of our clients, our summary of significant, I keep saying our clients' summary of significant accounting policies is one of the biggest notes to their financial statements. It's one of the biggest notes to their financial statements. Because their accounting policies around revenue recognition, we included it in there, okay? So we included a lot of the information in there. So you disclose the nature of revenue, where it comes from, sales of a product and service, sales of intellectual, type stuff, whatever it happens to be. For our government contractors, some of them, sold services, some of them sold services and a product. We do an ambulance service. The ambulance service, the nature of their revenues, or transport. You also had other type, emergency type things, different things like that. So you would disclose those type things. The amount Now, when it says, one of your disclosures is, you'll disclose the amount of revenue from contracts from customers recognized during the year. We did that on the income statement. That's not the notes, right? It confused me for a lot of years, when I was doing like a compilation that would omit substantially all disclosures, when management says, hey, we don't want any disclosures, and you can put that paragraph in there that says, management has elected to omit substantially all disclosures included here, blah, 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 right? And we would never have any notes. And I was like, why don't we just say we disclose, they are omitting all disclosures? Well, because some of the disclosures themselves can be on the face of the financial statements. So even some of these disclosure requirements under topic 606, you may have done on the face of the financial statements. Think about regular GAAP issues. When it comes to property, plant, and equipment, it talks about you disclose the nature of those and what it's made up of. So you might look on a balance sheet and see land, buildings, vehicles, computer equipment, accumulated depreciation. They may disclose it on the face instead of in the notes. And so some of these we disclose on the face. Well, we disclose most in the notes. The timing of it at a point in time or over time. The uncertainty of revenue and cash flows when it comes to variable consideration, the probability consideration may be going through. In 3 categories: contracts with customers, significant judgment, and assets recognized from the cost to obtain or fulfill a contract. And then that last line item says there will be qualitative and or quantitative disclosures required, which means you'll have words and numbers. Some require just numbers. Some require just words. Some require words and numbers. This has words and numbers. So you got them all, right? Where'd y'all go for guidance? I'm just curious. And if you don't want to tell me, that's fine.
I searched some SEC,
yeah.
same industry.
Yeah, you probably did it the same way most everybody else did. We would do like a Google search, disclosures under topic 606. We reached out to some other folks who might have gone through the whole process too. I told you I have some friends who work for Bits and Views, and so I knew that they had done some work early, and they had issued some non-authoritative type guidance early, and so I reached out to them. We did the same thing. We reached out to a number. We probably pulled from 5 or 6 different sources to come up with what we thought were the required disclosures in topic 606 for our customers and our clients. Because there's nothing in the standard that says, here is how you'll do it every time. Remember, the principles-based, not rules-based. There are times when I'm really glad they're principles-based, because we may be on a different side of the ledger, so to speak, with how we interpret it, and that's okay. But there's some times when I wish they would just say, do it this way. Here's your format. Just drag and drop, man. Especially when the number of and the time. But I understand this too. These aren't industry specific either. And we may have some industry specific disclosures that we may have to hit, and that's a lot of work for the standard set. So I understand the process behind it, but sometimes what was it, Staples at one point in time had the easy button. Just going to pop on that bad boy every once in a while. Hit the easy button. So we'll disclose contracts with customers. Revenue recognized from contracts with customers. Again, we showed this on the face of the income statement, and it was titled just like that. Revenue recognized from contracts with customers. We just say revenue from contracts with customers. And that's how we titled it on the income statement. Significant judgments made in applying the standard. Now that could be, that the judgments made were, retrospective, modified retrospective, how we wanted to do it, in the determination of how that was presented. It could be the judgments made on how we value variable consideration, how we determined at a point in time or overtime, all those type things. So significant judgments made. Any assets recognized from the cost to obtain or fulfill a contract with a customer. Did you all have any of those? Did you all have any of these contracts maybe that carried over to the next period where they had some contract costs that were required to be set up as a contract asset? that didn't have any recognition until that contract was satisfied. You know, in the past with our construction contractor folks, that was always included in our WIP anyway, our work in process, right? But now they say you take those contract costs out and you capitalize them separately. You recognize those costs separately. Those costs for our clients were immaterial, so they didn't set up any of them. Okay, we agreed with it. But think about it, if you've got maybe a big contracting firm that does a number of these where they've got some big costs associated, that could be the process. If you set up a contract asset, then you would also have disclosure regarding what those are. Now, the disaggregation of revenue. Everybody understands what it means when it says disaggregation of revenue? What does that mean?
Between products or services.
Sure. Yeah, you're showing the different types of revenue. Where did it come from? Just sales of a service, sales of a product. Now, what happens if they just sell one type product? Can you disaggregate it then? I think you can. Because we have some that's recognized at a point in time, some that's recognized over time. We had that with some of our GovCon people. You know, hey, they just dealt with government contracts. And some of them just did service contracts with them. But some were recognized at a point in time, some were recognized over time. So we showed disaggregate that way. Again, the standard itself doesn't tell you how you have to present disaggregated revenue information. They leave it up to management, those charged with governance, the accountant, and so forth. It just says you disclose. Because now on the face of the financial statement, you typically only have one line item. And so we just want to disclose, you know, my lumber mill. Now they just have revenue from contracts. And so now within there, they've got Southern Yellow Pine, they've got hardwood saw logs, they've got chip bark, dust, they got whatever like that. They disaggregate the way they typically have on the face of the financial statements for years. Again, some of the factors you'll consider: who sees these? What disclosures are made outside of the financial statement? Press releases, earnings reports. Man, my clients don't do press releases or earnings reports. So I don't really. Information reviewed by the chief decision makers, that was one of the determining factors on how much we showed and how they wanted it broken out. We just told them we needed to show it broken out, and they would tell us, well, this is what we typically like to see. Maybe they want it by product line. Okay? And because then they can make a determination, hey, we're only selling this much of it, and it's only this % of our gross revenue, then we'll make a determination on whether we continue selling that type of product or not. And then other information used to evaluate performance, either internally or externally generated. Your next slide will show some of your disaggregation examples. Major product line, sales in geographical regions. By market or type of customer. Contract duration, point in time or overtime. Timing of the transfer of goods, sales channels. One of the things that we ran into with one of our GovCon people this year, and these are our government contracting people, okay, and they deal with, most of them are service contracts with the government, okay? And so it says, hey, we'll provide staffing or service, people and so forth like that, and so they have certain rates that they use, certain costs can be included in that and everything. Well, there was, one of a lot of them get preferential contract treatment if there are certain types of entities, minority owned, those type things that they have set up. If they're recognized by the SBA as a small, they get preferential contract treatment and so forth. Well, so our tax department reached out to the audit side this year and said, hey, by the way, one of our clients, for years we've been showing revenue on the financial statements, as gross or whatever like that. But yet for the income tax return, we show it net because that's what the SBA gets. And, to stay up under their threshold of what a small business is, because the bottom line doesn't change, just how they present, revenues and their costs, we show it net on there. But we show it gross on the financial statement, so you could be looking at, these are hundreds of thousands of dollars we're talking with some of these contractors. And so they said, the clients asked why, why the difference? And they don't like having different, tax from financials. I said, well, that's not uncommon. A lot of people who have GAAP-based financial statements, for tax purposes, they're different. Construction contractors are that way, right? Percentage of completion versus completed contract. And so you may have some reconciliations in an M1 or M3, something like that. And so then I got down to the point, okay, by the way, does this contractor work as a principal or an agent? Because topic 606 is specific to that. If you're a principal, you show gross. If you're an agent, you can show net. Because they really wanted to kind of show net, so that's what they showed on the tax return, so that kept them within the threshold of what the SBA would recognize and so forth like that. And so we asked them for narratives of what they were. Were they a principal or an agent? And so they came back, and the narrative they gave us was quite opposite of what they wanted. And so we said, well, here's what topic 606 requires. So they're saying, so what we can, and they hadn't issued their financial statements yet. They're still contemplating what they need to do, right? And so, our whole thought then is that we hope there's not an intent to mislead, first and foremost, because we don't want to associate ourselves with an intent, with financial statements that where there's an intent to mislead. We're not going to associate ourselves with that. We're going to present them the way that the standard requires. And so they've actually gone back to really look in depth at their contracts to see how they actually are. And they're still working through that process. On whether they want to, apply topic 606. And they even thought that, hey, if we can show them that, then we can go back, we can do it this year, and what if we go back and recall and reissue the prior year? I'm thinking, what's the point? You have to be an early implementer of it. And you all obviously didn't do that. You can't retro. How can you go back and say, oh yeah, we were on the topic, we just forgot. So there's a lot of ins and outs on all this type of stuff. A lot of determination, bless you, presentation type issues that since it's principles based, we need to make sure we understand what it will allow and what it won't allow. Now when it comes to disclosing contract balances, opening and closing contract balances of receivables, contract assets, and contract liabilities. If you did not have any of these, obviously you don't have to disclose. Revenue recognized, but let's just say that you did have opening and closing receivables, contract assets, and contract liabilities. How would you disclose that? You could always do it on face of the financial statements, couldn't you? You got 1 year and the next year. That would handle opening, because you got the ending of the prior and the ending of this year, so that hits the opening and closing. You could do it within the notice of the financial statements, right? And if you had some of those set up, you disclose revenue recognized that was included in the contract liability at the beginning of the period, and then revenue recognized in the reporting period for performance obligations that were satisfied in previous periods, which means there was a change in the transaction price where they had to go back and reassess it. Again, change in contract balances applies to all contract assets and contract liabilities. You'll have qualitative and quantitative information when it comes to that. And then as far as how detailed you might get, you may have an impairment of a contract asset. That's one of the things that, I'll tell you, one of the things that I have thought about if we had contract assets, that it falls up into the impairment rules now. Yes, sir.
Talk about kind of some examples of what a contract asset might be, what a contract liability might be. What are we going to see in those buckets?
Yeah, with a contract asset, at least you might see things such as costs to obtain that contract. Okay, we're talking, you don't include them, you set those up separately. You can't, that would be a contract cost that you would capitalize.
Not like work in progress.
Not like where it's separate from work in progress, because that is specific to costs that it takes. Now, yeah, then that's separate. It wasn't before, right? We would include it in WIP, or contract construction process. Now we separate out those costs and we capitalize them. Okay, and we recognize them as that performance obligation is satisfied. Now, if it's over a period of time, then we'll amortize it. We'll amortize that asset over the period of the contract. Or if it's at a point in time, then once that performance obligation is satisfied, then we would recognize that point in time. Contract liabilities, I don't know that I've seen an example of what a contract liability might be, unless you have some deferred revenue. Maybe you have some prepayments possibly that are out there that could be a deferred revenue. And that would be a contract liability. That would
So
be
just unearned revenue would be?
just unearned revenue,
If
yeah.
it's a prepayment?
Absolutely.
that would be in a contract.
Yeah, and it's one of those, if you recognize over a period of time, you can amortize that just like you would a contract asset. Yeah. Good question. Anybody else?
One of the things I read on contract assets is it could be some work you put into a contract, but you can't bill it yet. You don't have the right to bill it yet.
Okay.
So, which I came across this engineering firm financially. They started working on a contract, but didn't have a signed contract.
Ah.
So they went ahead and they knew it was coming.
Almost like an R&D type cost in a way, except you've got some assurance that there'll be something. Yeah.
You got started.
Yeah. Interesting. And again, you know, that whole contract asset, contract liability would come up under the impairment test. Let's just say that, hey man, we heard, and then all of a sudden, word down the line is, not going to happen. Or the contract, the work that you had in place, we're willing to do 10% of that. So it could be an impairment issue that you got to test for impairment also. Yeah, it's a lot of fun to do this one, isn't it? Also disclose performance obligation. All entities will disclose when they typically satisfy performance obligations. If it's a service, it's satisfied as that service is performed. If it is sales of a product, it's when control transfers. And control transfers whenever I take that clip bar and I walk out the door. Or whatever it is I purchased, you know, stuff like that. You know, you'll describe what that is. What the significant payment terms are. Again, you may have some where you've got membership fees and some are payment over time. You would disclose, you know, payment terms, you know, interest rates if that's the case also, the nature of the goods or services promised. Any obligations for returns, refunds, or similar items, types of warranties, and related obligations. You know, I remember you talked about a publisher earlier. You know, you remember you used to, your magazine subscriptions, you know, hey, take this free for 3 months. If you don't like it, you know, then you don't have to pay and all that type of stuff. You would have some open terms where, you know, you may not know. You think about those type of things would be disclosed. As for public entities, we're not concerned about that. Significant judgments in revenue recognition. Determination of the timing of the satisfaction of performance obligations. Again, we determine these to be satisfied over a period of time because these are typically long-term contracts. We have the right to payment, and control having, you know, that type, we'll disclose those type things. The determination of the transaction price. We use a weighted average approach. We use a market assessment. We use the most reliable information that we could. And then the determination of the allocation of the transaction price. We allocate it on a systemic manner, or we normally allocate it just to one item within the contract, whatever it happens to be. It's a lot of disclosures. For us, it added about 2 pages of disclosures, I think, on average. All right. And again, we pulled from different resources. The bulk of our the bulk of what we did came from the Dixon Hughes Goodman. And you know, you want a copy that, I'll be glad to shoot it to you. I got it on PDF on my computer. I don't mind doing that. You can just kind of use it to kind of look and see. We do that even today. We'll go back and financial statements that have already been issued. If we get something else, we'll kind of take it and sit it side by side and say, hey, either we did okay, or ooh, we should have thought about that. We need to make a note going into next year that we should do better. Okay. Now here's your revised effective date. Well, one of the revised effective dates, right? Well, it has both of them on there. Annual periods beginning after December 15, 2018, so that will put us into the calendar year 2019. So for all of our calendar year 2019, so we've issued financial statements prior to June, they would have been required to implement revenue under Topic 606. For those interim periods in 2020, so interim period financial reporting this year, revenue under topic 606, but that last bullet point says that in June, FASB issued a new accounting standard update that pushed the effective date, delayed the effective date basically 1 year for both lease and revenue recognition standards. So if there were financial statements that had not been issued by June, your client could have said, well, we'll wait until 2020 to have implemented revenue under topic 606. So it would have given a 1 year delay. Okay? Any questions?
My comment, when the first one I did was for the engineering firm, so I was searching the SEC, large engineering firms, found some that had these big swings in revenue. When they put the standard, they had a bunch of changes in past revenue and all that. You start reading what they did, why they did it, and you wonder why they ever recognized that revenue
In the first place.
They were just, it was stupid stuff. You know, like, how did you recognize that?
I was going to ask, how many of you all looked at some public company financial statements? You know, they're a 3 to 5 year comparative, and I was even looking at some 10Ks and some interim stuff that they would do, and they would report revenue under topic was a pre-606. And I'm like you, I'm like, that's a big difference. And that's why, we've all been leery this year. Did we do it right? You know?
Or is that why we got the standard?
And
large public companies were really doing it wrong.
Listen, public company drives everything. Every standard we have is driven by a public company. Okay? And it could very well be that that's what it was, is they had taken so much liberty in the past to manipulate revenue that this one doesn't necessarily allow, even though it's principles based, right? And so that very well could be what it is, because I was like, I looked at some of those financial statements, I was like, man, either we just got really good clients who have either hidden something or shifted or done whatever, or we've kind of missed the boat. But I look back at our work, and I think we've done the work in accordance with what 606 requires, and I think our clients have done it to the best of their ability. We'll see. We'll see. But I will tell you this. The same thing I'm hearing from you all was the same thing I heard from the firm on Tuesday, was the same thing that I've heard from a firm up in Nashville that I did an A&A update for them a couple of weeks ago. The same thing. We're just not seeing the difference in the numbers. At least not significant differences in either the timing or the bottom line. And so that either tells me we're all wrong or we're all pretty close. All right? Okay. That's your revised effective date. Now, there's been some transition guidance, right, that tells you, and I don't know how you all handled it. For most of our clients, we showed single year presentation. In fact, I can't recall any who we showed comparative financial statements, unless they required it. But again, I can't. Maybe the ambulance service did. I'm trying to think of all the ones that went through our Huntsville office, and I just don't recall seeing many that weren't single year presentation. You could have selected a full retrospective approach, which means if you're showing comparative, you take it back to the earliest period presented. Or you could use a modified retrospective approach, which means you could apply guidance as of the date of initial adoption. Okay? And it could be, we did a modified retrospective on that. It's not a fear because we weren't seeing a big difference in the numbers. But you can think about, maybe not looking apples to apples, but they're so similar. Your disclosure requirements would have been different. Okay? If you're disclosing for both periods, then that could be different. But other than that, from the numbers wise, I don't think we had a problem. Oh, there's a question, polling question, so we don't take a test at the end. I would have forgotten to give you the test anyway, right? How many companies issued comparative financial statements? By the way, did y'all do comparative or? Yeah, okay.
Because there's no change.
Because there's no change. Did y'all do full retrospective or modified?
We said full retrospective.
Okay. All right. Yeah, I mean, because it ain't got nothing to restate, right? If it didn't change, you don't have to restate. Yeah. You just change some of your terminology and go forward. Yeah, perfect. Pros and cons. Transition issues. Of course, there's ongoing joint research by the FASB and the International Accounting Standards Board. There are these joint transition resource groups. They have issued several ASUs. If you followed this topic in any way, shape, or form, you would probably know that there were probably at least a dozen ASUs issued in regards to topic 606 before the effective date was even in place. Be it technical corrections, be it clarifications, be it additional guidance on what qualifies as revenue and so forth like that before we could even put it into place. And so again, you've got a lot of these TRG memos, these transition research source group memos. You know, and this goes through, so we won't take the time to go through these type things. But these are just selected ASU topics that have been issued. Completed contracts, transition disclosures. There are some of these prepaid store cards, how you handle those. Principal versus an agent. This is the one I brought up earlier, talking about whether you report as gross or net. We did actually get into that one because we had a client specific who was really concerned on whether they could show net or whether they were required to show gross or whatever.
What were they getting at? They were subcontractors?
Some of them were subs and handled it that way. And so again, to qualify under the SBA, they had to be under a certain threshold. So for tax reporting purposes, they would show it that way. Well, then on the financial statement, we had always shown things gross. And so that's where we really got into, okay, what is it you all do? Are you an agent or are you the principal? And so they had to go in that whole consideration with that. Okay. Licensing, again, you know, is it standalone property? Then it's overtime. If it's not, then it may be at a point in time. Technical corrections, again, I've sat on a standard setting board. And it's not easy. When we wrote SARS 21, there were 6 of us on the ARC that wrote SARS 21. And so, you know, we would meet probably 4 or 5 times a year for about 2.5 days. And for 8 to 10 hours a day, you know, we were going through the standard, trying to write. You know, at the end of the day, we're like, dang good stuff. And we'd go out to eat, get some sleep, wake up the next day going, what were we thinking? It's awful. You know, and there's you can look at something for so long. If you ever built a house, anybody ever built a house in here? I had a house built. My wife and I, you know, gone through the whole home building thing. We're like, this is our forever home. It's perfect. It's great. We get in there and like, well, next time I'll probably flip that around. Might change. That's what they've done here. You know, you're writing a document that's 700 some odd pages that spans a time period of 10 plus years where you've had committee changes and rollover that you're not having the same person write. So that's all these technical corrections and improvements do. There are some areas that were written better, some that were not written as well. And so that's all this 2016-20 does. It just kind of clarifies and gives some technical corrections to some of those. Service concession arrangements have to do with governmental entities that may rent, you know, utility spaces and stuff like that. Not-for-profits, this is the not-for-profit guidance on determining whether these grants, contributions received, contributions made, whether those grants should be included as revenue or contributions. You know, is it a contribution, not 606, or is it an exchange transaction, 606? And the determination of donor or imposed restrictions. If y'all do not-for-profits, this one's pretty important actually. You know, a transaction must be either a contribution accounted for under 958 or an exchange under topic 606. And so it's an exchange if you expect to receive commensurate value in return. Good feeling is not commensurate value. You know, I pay my $200 and I feel good because that's helping out. That's not commensurate value. The general public is not synonymous with a resource provider. So, you know, you pay $200 a year to your local hospice, okay? And what do you get in return? Yeah, I get that good feeling because hospice, I think, does a great job of what they do. It takes a special person to do the job that they do. But it just gives me good. If I don't get anything commensurate value in return, yeah, if I was, I wouldn't be here today, right? For what they do. And so you got to determine. You get commensurate value for what you pay. Membership fees, commensurate value or not. You know, you go to these fundraisers, commensurate value or not. Typically, you'll default to the contribution if it's not classified as an exchange transaction. Then it goes into the whole donor imposed restrictions. And we won't take the time to go through all that. Again, FASB website has a lot of good guidance. 60 memos have been issued. Now, this is November 2018. They've issued a few more since then. And again, there are actually guidance in some of their staff accounting bulletins also. Connected concept. I don't know that we're going to take the time to go through that.